Imagine standing at the shore, watching the ocean's waves. Some waves are small and gentle, others larger and more powerful, yet all part of the same vast body of water. Understanding market trends is much like watching these waves. The markets move up and down, driven by a myriad of factors, yet there's an underlying rhythm and reason to it all. Let's start by exploring a foundational truth. Markets are influenced by human behavior. Picture this. Back in 1637, people in the Netherlands went wild over tulip bulbs, driving prices to extraordinary heights, only for them to crash dramatically. This was one of the first recorded financial bubbles, a perfect example of how fear and greed, two powerful human emotions, can sway markets. To understand market trends, we must first recognize the role of these emotions. When investors are fearful, they often sell, causing prices to drop. Conversely, when they're greedy, they buy, pushing prices up. It's a dance, a continuous back and forth that can feel unpredictable. Yet trends don't just happen randomly. Think of them like seasons. Just as you'd expect warm weather in summer and cold in winter, the market has cycles. We often hear terms like bull and bear markets, named after the way these animals attack, bulls thrusting their horns upward and bears swiping down. Bull markets signify rising prices and optimism, while bear markets indicate falling prices and pessimism. But remember, neither lasts forever. The key is to observe how trends shift over time, which can reveal valuable insights. Let me share a personal perspective. When I first began investing, I was fixated on finding the perfect moment to buy. I was constantly checking the news, looking for signals. But over time, I learned that trying to time the market is much like guessing when the next wave will hit the beach. Instead, I focused on understanding longer-term trends and the underlying economic factors driving them. Look at technology stocks, for instance. In the late 1990s, the dot-com bubble burst, yet years later, technology has become an integral part of our lives, driving growth in ways we couldn't have imagined. A useful mental model to consider is the concept of reversion to the mean. This is the idea that prices and returns eventually move back towards the long-term average or mean. If a stock or market index is much higher or lower than its historical average, there's a chance it could move back towards that average over time. This isn't a certainty, but it's a reminder to stay grounded, to not chase after every peak or panic at every trough. Of course, it's not just about numbers and cycles. It's about mindset too. Embracing a calm, disciplined approach can help you ride the market's waves with greater ease. It's essential to have a plan and to stick with it, even when emotions run high. Building long-term wealth isn't about getting rich quick. It's about making smart, informed decisions consistently over time. As we wrap up, think of the market like the ocean. Vast, sometimes unpredictable, but navigable with the right tools and understanding. Each trend is a wave, and your job is to learn when to ride and when to step back. Reflect on what drives markets, how human psychology plays its part, and how trends mirror deeper economic realities. Let this knowledge guide your journey, helping you stay the course with confidence and clarity. Remember, the market may ebb and flow, but with patience and insight, long-term wealth is within reach.